Hi everyone, it's your daily 10-minute business and finance news wrap from the SBS newsroom for this Friday, the 11th of February 2022. Later, the US inflation rate hit a 40-year high annually. What does that mean for shares and official interest rates? We'll find out soon. But first, to the gender pay gap, which is narrowing but only slowly at a rate of 0.5% in the last year. Workplace Gender Equality Agency says men are twice as likely than women to earn more than $120,000 a year, but women are 50% more likely to earn less than $60,000 a year. To find out more, Danielle Robertson spoke with the director of the WGEA, Mary Woolridge.
We've seen, as a result of our annual census of employers with over 100 employees, is that there have been some small improvements, but the rate of change is very slow. The gender pay gap, representing full remuneration that men and women earn, is 22.8%, representing nearly $26,000 differential between men and women. We've also seen some stark numbers in terms of the representation of women at the most senior management levels and leadership of organisations. 22% of boards have no women on them, and 75% of boards have a significant majority of men, 60% and over. Interestingly, of those who have a majority of men, only 12% have set a target to try and address that, and the target is quite low, only 35%. So women are underrepresented and undervalued across businesses, and it's something we need to change.
Is there like a top three main industries where the pay gap is the widest, and what are they?
So the significant industries are particularly the construction industry, which has taken over actually as the industry with the highest gender pay gap. In the construction industry, this pay gap has actually increased over the last 8 years. It's only one of two industries where the numbers have gone up rather than down. The second highest industry is financial services. They have a 29% gender pay gap, but interestingly, there has been a concerted effort within the sector to reduce the gender pay gap, and that's come down 9% over the last 8 years. A very concerted and focused effort from industry leaders to address the gaps between men and women. Now, the gap is still big, but the trajectory is absolutely in the right direction, and that's what we need to see. There is evidence. If you do gender pay gap audits, if you set targets to drive change, if you report the information to your board and held accountable for delivering on the change, then change can be achieved.
I guess overall, you were saying we haven't really made much change over time. It's been quite incremental. Why do you think that is?
So what our research shows is that it's going to take more than 25 years to reach gender equality in our workplaces. And in an area like chief executive officers, where there's currently less than 20% of all chief executive officers are women, it's going to take 80 years for there to be equality in that area. The trajectory is in the right direction, but the rate of change is very slow. We know that gender equality, greater representation of women across businesses and in senior management and leadership roles is good for business. It's good for productivity, it's good for profitability, it's good for your results on the stock exchange. But what we're not seeing is the drive that needs to happen to realise those benefits, and also realise the benefits for your workforce to be working in a more equal workplace where everyone's valued for who they are and the work they can contribute.
Mary Woolridge there. She's the director of the Workplace Gender Equality Agency, speaking with Danielle Robertson. Let's take a look at the Australian share market now, which has ended the week on a down note. The S&P ASX 200 down 1% to 7,217. It follows a US inflation read of 7.5% annually. That is the highest rate in 40 years and may push interest rate rises forward and maybe even faster. For more, I spoke earlier with Bogdan. He's the Chief Investment Officer at Blackore Capital.
Well, there's certainly some sticker shock there with a annual inflation rate of 7.5%, and that was above market expectations. And it really highlights the persistence of inflation, particularly in the US. And I think the more concerning element was the breadth of inflation that you're now starting to see across households, energy, vehicles. It's just the sheer breadth of the inflation which has caught the markets on the hop.
So how exactly did it impact the markets today? What led the falls?
So predictably, it's those long duration assets such as technology and utilities are those companies that are really sensitive to higher interest rates. But on the other side of it, materials and energy actually have done reasonably well, and in financials. They tend to do better in a rising interest rate compared to technology and other long duration assets.
So is the shock here the fact that the US Federal Reserve may in fact now lift official interest rates there faster and stronger than first thought?
Well, you're absolutely right. There has been a profound change, and the change has been significant, and it's been faster than anticipated. So overnight, US investment banks are suggesting there could be 7 interest rate rises for the remainder of 2022. That's up from 5 rate increases just earlier this month, and at the beginning of this year it was only 4, and 6 months ago there was expectation of no rates in 2022. So that's how significant the change has been over the last 6 to 9 months.
So how does this all play out in the way you're investing if we're seeing stronger inflation and the potential for faster and stronger interest rates this year?
Well, it does change things at the margin. It does make potentially financial stocks, banks and insurers that generally benefit from higher interest rates, certainly in the initial stages of interest rate rises. And then obviously there's concern around inflation. And so resource and energy stocks have continued to do well. And so I think that's the pivot, certainly in the short to medium term. Resources, energy, financials, and more value-orientated stocks rather than technology and those stocks that are really sensitive to higher interest rates.
Okay, maybe one final question about the local market and some local news. I know profit reporting season's coming. We're on that right now. But what caught my attention, the ACCC has given Wesfarmers the tick of approval to buy API. So what will this mean for the company? And will consumers see any difference?
Well, it's an interesting move from Wesfarmers, and can you remember that Wesfarmers has an incredibly strong balance sheet, so they're always looking to make some acquisitions, and they've tilted towards health and wellness, which is a fast-growing sector in the economy, probably far more pronounced because of the pandemic. But I think it's probably an initial step for Wesfarmers because API has got a market capitalisation under $1 billion. Wesfarmers is around $60 billion. And so I think it's the first step into that category, into retail of health and wellness. And it'll be interesting to see whether they look to vertically integrate into further healthcare assets into the future.
Bogdan there from Blackore Capital. This SBS on the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.